All right, let's jump right in. We're looking at Ciena Corporation's latest fiscal results and, maybe more importantly, their forward guidance.
Exactly. And this wasn't just a good quarter. This looks like a major inflection point.
The market certainly thought so.
Oh, absolutely. Ciena put up record Q4 revenue,
Mm.
about $1.35 billion. That's up a solid 20% year over year.
But that's not what drove the stock up over 5%, was it?
No. The real story, the reason for that pop was the dramatically accelerated outlook for fiscal year 2026.
Okay, give us those headline guidance numbers. They really set the stage for everything else.
They raised their revenue guidance for 26 to a range of $5.7 billion to $6.1 billion.
Okay.
So if you just take the midpoint of that, you're looking at around 24% annual growth. For a company this size, guiding to that kind of growth is a huge statement.
It's a statement about the demand they're seeing. Okay, so let's unpack Q4 25. What gave them the confidence to guide that high? Revenue was $1.352 billion, up from about $1.12 billion last year.
And that's where you see the operational leverage. For you, the investor, this is the key. Look at the adjusted EPS. It came in at 91 cents.
Which is a huge jump from 54 cents a year ago.
A 69% increase.
Yeah.
When your revenue grows 20%, but your earnings per share grows almost 70, that tells you they're getting so much more efficient.
And the margins?
Adjusted operating margin jumped from 10% to 13.2% in just the quarter.
That's impressive for a quarter. What about the full year? Did that efficiency hold up over 12 months?
It did. For fiscal 25, revenue hit $4.77 billion. That's 19% growth. And the annual adjusted EPS was $2.64, up 45%.
So still very strong leverage.
Very. But if you want to see the health of the business, you have to look at the balance sheet. They improved their cash conversion cycle by 34 days sequentially.
34 days, that's not a small adjustment. That's a massive operational improvement. How?
Two things, really. Collecting cash faster and moving inventory faster. Their DSO days sales outstanding. They drove that down to 77 days.
Down from what?
From 89. So they're collecting cash 12 days quicker. And at the same time, their inventory turn sped up from 2.7 to 3.1. It all just flows through the system faster.
And that generates cash.
It generates a lot of cash. $665 million in free cash flow for the year. And they're putting it to work, too, buying back about $330 million in shares.
Okay, so the core business is a well-oiled machine. It's efficient, it's generating cash. But that still doesn't explain forecasting a jump to 24% growth for 2026. That has to come from a strategic shift.
It is. And the shift is all about who is buying the gear. We've crossed a really critical threshold here.
What is that?
Ciena is no longer, primarily a telco supplier. Non-telco revenue was 55% of their total in Q4.
55%. So they are officially a majority non-telco company now. Who's driving that?
It's the cloud providers. And the speed of this shift is it's massive. Direct cloud provider revenue grew 49% year over year.
49%.
And they now account for 42% of total revenue. Just a year ago, that was 34%. This is the AI infrastructure boom, plain and simple.
Okay, well, let's spend a minute on the why here. Why are the cloud giants suddenly so desperate for connectivity? Ciena called it the critical long pole in the tent.
It's because they have a huge expensive problem. The cloud providers have spent, tens of billions of dollars on GPUs, on the AI compute clusters.
They bought the supercars.
They bought the supercars, exactly. But they kind of forgot to build the highways between the cities. They, and this is a quote, underinvested in their networks to date relative to compute.
So all that expensive compute power can't talk to each other efficiently.
Right. To actually train these giant models, the clusters have to be spread out geographically, but they need to function as one single brain. Without the high-speed optical network Ciena provides, a lot of that GPU power just sits there, underutilized. And that is a terrible return on investment.
So they have to play catch-up immediately.
It's an emergency catch-up. And that urgency is why you see Ciena's pipeline just exploding. They booked a record $7.8 billion in annual orders.
Wow.
Which leaves them entering fiscal 26 with a record backlog of about $5 billion.
That is incredible visibility.
It is. $3.8 billion of that is the high-margin hardware and software. But you also have to look at the other side of that coin, which is the risk.
The customer concentration.
In Q4, just 3 customers, 2 cloud providers, and AT&T made up just under 44% of all revenue.
That is very concentrated. Does that worry you?
It's a trade-off, right? On the one hand, yes, losing one of them would be a massive blow. But on the other hand, it proves that Ciena is strategically essential to the biggest, richest companies in the world.
Because they're not just buying a component, they're building their entire AI backbone on Ciena's architecture.
Exactly. It's a multi-year, multi-billion-dollar relationship. And that provides the confidence to put out the kind of guidance we're seeing.
Let's get back to that guidance then. Because that 24% revenue growth is only half of it. The profitability outlook is where things get really interesting.
And it really is. For 2026, they're guiding to an adjusted operating margin of 17% plus or minus 1%.
17, what was it for the full year 2025 again?
Just over 11%, 11.2 to be exact.
So they're forecasting a 6-point jump in operating margin in a single year. That seems incredibly aggressive, especially when they're trying to integrate the Nupus acquisition.
Well, it comes down to two main things. Product costs coming down and really strict discipline on spending.
Okay.
First, as they ramp up production of their new products, especially the 800 gig pluggables, the unit costs just fall off a cliff. Scale helps a lot. Second, pricing. They've already negotiated new pricing with customers, and the full effect of those contracts hits in 26. And the most important part, they're going to do all this while keeping their operating expenses basically flat.
Flat OpEx with an acquisition baked in, while revenue grows 24%.
That is textbook operating leverage. That's how you get that massive jump in profit.
Okay, looking at the very near term, Q1 guidance is strong. But what's the biggest challenge for them right now? Is it demand?
No, it's supply. The CFO was very clear on this. He said Ciena is essentially sold out for Q1. They could sell more if they could build more.
Which explains their CapEx plans. They're spending a lot more than usual.
They are. About $250 to $275 million.
Yeah.
And you have to ask, what are they buying with that money?
So what are they buying?
They're buying the future. A lot of it is production capacity, sure. But the critical piece is they're spending on 3-nanometer mask sets. These are incredibly expensive, but they are absolutely necessary for the next generation of components they need to meet demand in 2027 and beyond. It shows you how confident they are in this multi-year cycle.
Okay, let's pivot from the numbers to the actual products. What specific solutions are winning these massive AI deals?
You really have to look at 3 key areas. First is what they call their scale across architecture. Think about it. To train a model with 1 trillion parameters, you can't have all the GPUs in one building. It's just not feasible. They have to be spread out across data centers, sometimes across continents.
And scale across is what links them together to act like one giant computer?
Precisely. It's the architecture for a single massive AI factory. And the big news is they've been adopted by 3 of the 4 major hyperscalers.
3 out of 4. That's a dominant position.
It's a phenomenal position. And the revenue from those huge multi-year deals starts to really kick in during 2026 and then scales up heavily in 27.
Okay, so that handles the long distances. What about inside the data center? I saw they mentioned DCOM. What is that?
DCOM is Data Center Out-of-Band Management. It's a solution they initially developed with Meta.
And what does it do in simple terms?
It's like having a separate private network just for managing all the networking equipment. Usually you manage the switches and firewalls through the servers themselves. DCOM creates a completely separate path.
So it's like a dedicated IT department for the network gear.
That's a great way to put it. It streamlines everything, reduces human error. It's a huge operational win, and it gives Ciena a new foothold inside the data center. It's already running in Meta's DCs, and they're talking to other hyperscalers about it.
And what about their more foundational hardware? The reconfigurable line system, RLS, saw 72% growth.
RLS is the plumbing. It's the foundational optical layer. And hyperscalers need it to be reconfigurable because their traffic is so unpredictable.
Meaning they can change the bandwidth on the fly.
Exactly. They don't know if a connection needs 400 gigs today or 800 gigs tomorrow. RLS lets them dial that capacity up or down instantly without a truck roll, without swapping hardware. It's essential for managing these explosive AI workloads.
So this whole in and around the data center market for them tripled in 1 year. That really shows the shift. And the coherent pluggables are the tip of that spear.
They absolutely are. Revenue from pluggables more than doubled to over $168 million in 25. And now the next generation is here. Their WaveLogic 6 Nano, the 800 gig pluggables, are already shipping for revenue.
And they sent the 800ZR version out for testing, too.
To 3 cloud providers, yeah. It just confirms they have that first mover advantage in the highest speed components.
And the Nupus acquisition is meant to push them even deeper inside the data center, right?
It's all about getting closer to the GPU. Nupus gives them technology for the high-speed electrical interconnects, the switching fabric right next to the compute. It's a classic vertical integration play, and we should see the first products from that in fiscal 26.
We've focused almost entirely on the cloud providers, and for good reason. But Ciena's traditional telco business, is it just fading away?
Not at all, and this is what makes the forecast so robust. It's really a dual-engine growth story. Service provider orders were up nearly 70% for the year.
70, wow.
Yeah, part of that is just normal network upgrades, but a lot of it is also AI-related. They're building what are called managed optical fiber networks, or MOFNs.
Okay, break down that acronym for us.
A MOFN is basically a telco acting like an AI real estate developer. They build and manage a dedicated, super high-speed fiber network just for a hyperscaler, keeping all that AI traffic separate from, consumer Netflix traffic.
So they're building private highways for AI.
Exactly.
Okay.
We saw a huge win like that in India, with 2 service providers for 1 hyperscaler and a bunch of others in new regions.
And that work, installing all this new gear, that feeds into their services segment, which was also up big, right?
Global services revenue grew 25% year over year. But look at the implementation services number specifically. That was up 34%.
And that's a key metric.
It's a crucial proof point. It tells you the gear they're shipping isn't just sitting in a warehouse. It's being installed and turned on immediately. This is real consumption-driven demand.
And the most telling stat of all might be who their biggest services customer was this year.
For the first time ever, Ciena's largest services customer was a cloud provider. That tells you everything about the shift in their business. The hyperscalers are leaning on Ciena not just for boxes, but for the expertise to build these incredibly complex global networks.
So to wrap this up, it seems Ciena is perfectly positioned to capitalize on this massive AI-driven network build-out. The growth trajectory has fundamentally changed.
That's the summary. But for you, the informed investor, the final thought has to be about execution and risk.
Go on.
They're spending a lot more on CapEx to secure capacity, buying up those 3-nanometer mask sets. They're sold out in the near term. They had the big hyperscaler design wins. The question is no longer about whether the demand is real. It is.
So what is the question?
The real risk and the real question going forward is whether the global supply chain for these highly specialized components, the high-speed photonics, the optical parts, can actually keep up. Can they meet these massive 2027 scaling targets without hitting sustained lead time issues or cost overruns? That is the one thing you have to monitor over the next 18 to 24 months.